All right, let's talk about Tesouro Direto. We're going to break down one of Brazil's most popular investments, and my goal here is to show you exactly how it works, what the big risks are, and how to avoid them, and really the core strategy you need to use it like a pro. So let's dive right in. So let's start with a kind of interesting question. What if you could become the government's banker? I mean, think about it. When the government needs money to build things, roads, hospitals, or to fund its programs, it has to borrow. And through Tesouro Direto, it can borrow that money directly from you. And this is what Tesouro Direto was all about. It's this program, launched way back in 2002, that honestly changed everything. Before this, lending money to the government was really just for the big guys, banks, huge investment funds. But now, with just a few clicks and for as little as about 30 reais, literally anyone can become a creditor to the country and earn interest on their money. Now, here is the most crucial point. It's safety. We call it the safest investment in the country for a reason. You see, a company can go bankrupt, right? But the government has powers no company has. It can collect taxes. It can even, in theory, print money to pay its debts. That's why government bonds are seen as the bedrock of safety in any financial system. So how does this actually work when you go to invest? The best way to think about Tesouro Direto isn't as one single thing, but more like a financial toolkit. And inside this kit, you have 3 very different tools, and each one is designed for a very specific job. So the 3 main tools in your kit are the Tesouro Selic, the Tesouro Prefixado, and the Tesouro IPCA Plus. And listen, picking the right one is everything. It all depends on your financial goal and, really importantly, your timeline. Let's break down each one. First up, we have the Tesouro Selic. Think of this as your reliable workhorse. Its return is directly tied to Brazil's main interest rate, the Selic, so it moves with the economy. And because its price almost never goes down, it is the perfect, and I mean perfect, place to keep your emergency fund or any money you know you might need soon. Next, we've got tool number 2, the Tesouro Prefixado. The name kind of gives it away, right? Prefixed. With this one, you lock in a specific interest rate from day one, let's say 11% a year. You know exactly what you're going to have when it matures. This is great for a goal with a firm deadline, like a down payment on a house. But there's a catch, a pretty big one, if you need to sell it early. And finally, our third tool is the Tesouro IPCA Plus. Think of this as your ultimate shield against inflation. It guarantees you a return above whatever the official inflation rate is. This makes it, without a doubt, the champion for long-term goals like retirement. It ensures your money actually grows and doesn't just lose its buying power over time. But, and you've probably guessed it, this one is the most volatile of all if you sell before that maturity date. And that word, volatility, brings us to the biggest hurdle for almost every new investor. It's something I like to call the daily price trap. And honestly, understanding this one concept is the key to winning with Tesouro Direto. You could just imagine the feeling, right? You invest your hard-earned money. You log into your account excited to see it grow, and instead, you see a negative number. You're losing money. And you're thinking, wait a second, how is this possible? I lent my money to the safest institution in the entire country. Well, the answer has this kind of fancy-sounding name, mark-to-market. But the idea behind it is actually pretty simple. All it means is that the value you see in your account isn't what you originally paid for the bond. Instead, it's what someone else would be willing to pay for it on the open market today. And that price, well, it changes every single day. This is where the seesaw effect comes in, and it's a perfect way to picture what's happening. Just imagine you bought a bond that pays you 10% a year. But then, a month later, the government starts selling new bonds that pay 12%. Well, who's going to want to buy your old 10% bond? Nobody, unless you sell it to them at a discount. And that's the relationship. When new interest rates go up, the market price of your old bond goes down. It's a seesaw. So when you see that price drop, you're really at a fork in the road. Path number 1 is the panic mistake. You see the red, you get scared, you sell immediately, and you lock in a real permanent loss. But path number 2 is the smart strategy. You just ignore the daily ups and downs. You hold on to that bond until its maturity date. And if you do that, you are guaranteed to get the exact interest rate you were promised when you bought it. The daily noise doesn't matter. Okay, so how do you make sure you always take that smart path? How do you turn this whole scary daily price trap into something that's just completely irrelevant? Well, the answer is surprisingly simple and actually pretty elegant. It all comes down to one single powerful rule. I call it the golden rule of Tesouro Direto, and it's this. The maturity date of your bond must match the deadline of your financial goal. If you do this, you will never, ever be forced to sell early at a loss. It's that simple. So here's your action plan. It's just 3 steps. First, define your goal. Be super specific. What are you actually saving for? Second, set a deadline. When exactly are you going to need this money? And third, go into the Tesouro Direto program and find a bond that matures on or just a little bit after that specific date. That's it. That's the whole game. And here's what that looks like in the real world. Say you're building an emergency fund. Well, your deadline is anytime, right? So only the Tesouro Selic makes sense. Planning to buy a car in about 3 years, let's say 2029. A Tesouro IPCA Plus that matures in 2029 is a perfect choice to protect your money's value. And for retirement, 20 or more years away, a super long-term bond like the IPCA Plus 2045 is exactly the tool for that job. All right, let's bring this all home. If you want to master Tesouro Direto and really use it to your advantage, there are just a few key ideas that you need to have locked in. Here are your takeaways. Number 1, always use the right tool for the job. Solic for short-term safety, IPPA Plus for long-term inflation-protected growth. Number 2, master mark-to-market. Just remember, it's only a risk if you sell early. Patience is what guarantees your return. And number 3, the most important one, always, always follow the golden rule. Match your bond to your goal. And of course, just a quick and important reminder, everything we talked about today is really for informational purposes. It isn't personal financial advice, okay? Your situation is unique and all investing does involve some level of risk. So, if this deep dive into how government bonds and interest rates all connect has got your curiosity going, and you want to understand the bigger economic forces that make those rates move up and down in the first place, well, I know just the place for you. You should absolutely check out and subscribe to the Macroeconomia channel on YouTube. They do more awesome explainers that connect all these dots between big economic ideas and your own investments. Thanks so much for watching.